Hello and welcome to our weekly look ahead at the markets. And just a brief recap, because we've had a very busy week for central banks. Of course, the Fed, in its hawkish pause, decided not to raise interest rates, but it maintained the dot plot as it was at 5.6% on the median Fed funds rate. That implies maybe there's one more hike in the can this year. And also the big one was really the revision to the 2024 dots. They were moved up aggressively from 4.6 to 5.1%, whilst inflation forecast was maintained at 2.5%. So that implies more restrictive policy than currently. So more restrictive going forward, higher for longer was the message. And we saw fixed income markets move to reprice quite aggressively. The 10-year Treasury note yield up to 4.5%, first time since 2007. The 2-year to 5.2% high since 2006. And real rates also moving up quite steeply. So the 10-year tips up to 2.1% or above. That's its highest since 2008. So bigger repricing in fixed income markets last week, and that's driven, of course, some moves in the dollar. We saw the euro and sterling touching these 6-month lows. So movement across FX as a result of the bond market. And then with other central banks, of course, the National Bank of England decided to pause. It's also maintaining a kind of higher for longer messaging. But perhaps it might need to be teeing up rate cuts next year. We're not quite sure, but the economic figures are not great from the UK. So if inflation continues to come down as steeply as it did in August, then the Bank of England is actually going to be moving towards cutting sooner than expected next year. So it may struggle to maintain that higher for longer messaging. Bank of Japan, outlier, of course, unchanged in terms of policy. No real movement on normalisation. And the yen weakened a bit on that announcement. And that is despite the inflation numbers, which came out alongside the Bank of Japan, or at least on the same day. The inflation figures showing core inflation really quite hot, and 17 straight months now that inflation has exceeded the Bank of Japan's 2% target, and yet it's still saying that it needs to see that 2% figure hit sustainably before it will move. So it looks like the Bank of Japan is not going to get that quiet exit that Governor Ueda would like. We also saw the Riksbank in Sweden, the Norges Bank in Norway. They raised interest rates. Turkey's central bank went for a jumbo 500 basis point hike, and the Swiss National Bank decided to pause as well. So lots happening in central banks over the last week. That has implications for what's happening going forward, of course. So we're seeing bond yields move up. That's hit the stock market. Nasdaq was down 5% over 5 sessions running into Friday. And really generally seeing a bit of a pullback in equity markets with the dollar firming up and rates higher. Going forward, therefore, we're looking at some inflation numbers out of the US. That is important, but actually I think probably you need to be looking at the weekly unemployment claims numbers more than the inflation figures. I think inflation's coming down. It's going to be really hard to get it down to 2%. That's not really the game now. The game is how long you maintain restrictive policy and whether or not the labour market starts to really crumble. So look for those weekly unemployment claims numbers. They're probably more important than the inflation figures these days. Elsewhere, US politics is going to be front and centre in the coming days, because we have we have impeachment hearings, first impeachment hearings for Joe Biden. Now, he's not going to get impeached, but it's going to be interesting to see how that one plays out. And then more importantly for the market, as we run into the quarter end, month end, last week of September, we have this potential government shutdown in the US. So keep your eyes on that one. That could spark some concerns about spending in terms of government spending, and also consumer spending, jobs, and so on. So keep your eyes on that Republican caucus that's holding out, refusing to sign off on this budget deal. So we'll see how that one plays out over the coming days. But PIMCO was out with a note earlier this week saying that they think a prolonged government shutdown is very likely. So keep your eyes on that one. That's it for now. Thanks for watching.